This is Pat Berry from Dallas, Texas. We're at the Dallas Petroleum Club right now having a nice lunch, and we were basically talking about the general structure when you make investments into the oil and gas business. So a lot of our clients use an entity called an LLC, or a limited liability company. What that does, it allows you a lot of flexibility in the way you structure your investments, because from an LLC you can then elect to be like what we call a sole proprietorship, or you could possibly even have a partnership or a regular corporation, all from one entity. So once you're an LLC is set up, then from then you can make elections. We call them check the box elections each year on how you want your taxes structured. So that's basically what it is. That's why a lot of our clients use LLCs for these investments.
Well, for the Australian investors you're
yes,
talking about.
For Australian investors.
There's quite a few tax incentives, aren't there, for Australian investors
Yes.
investing in oil and gas in the States?
Yes, there are. There's deductions and incentives on both the money you put into it and the money you get out of it. So your investments going in are very favorably tax deducted. So a lot of the expenses that you pay are for things such as intangible drilling costs, for depreciation expense on equipment that you put on a well, any kind of salaries and wages that you pay in drilling a well. All these are currently deductible. And then certain costs are amortizable over a 2-year period of time. But the point is, of the money that you put into it, probably half of it approximately may be deductible the first year.
Yeah.
And then the rest of it may be deductible over the next few years. So eventually everything that you put into it, you should get a tax deduction for. So the second part of this is your income when it comes back into you is favorably taxed then, because you get what's called a depletion allowance. You can get either cost depletion, or you can get what's called statutory depletion and deduct 15% of the gross oil and gas sales as a depletion item on your tax return. So this effectively can shelter as much as 50% of what you're actually collecting, the way that the numbers work out.
Yeah.
So your depletion rate can be very favorable. So that's basically the tax rules. If you're in the oil and gas business, you want to make sure that you're allowed to take all these deductions if you need them. In some cases, we don't want to be in a limited partnership. We may want to be in an entity that doesn't limit our liability. So in some cases, some people can make straight investments from Australia straight into the entity, not limit their liability in any way, and if that case, they can even take more deductions. So it depends on what they want to do.
Yeah.
So every case we have to analyze everybody's case individually, because they're all a little bit different.
So basically, let's say, for example, we've got someone from Australia who says, yeah, I'm investing in oil and gas with ASC. You'll be able to sit down with them virtually, or like on the phone, or through maybe like a conference call, and be able to speak to them and find out what structure is best for them to get maximum tax advantages.
Yeah, not just that. Find out what their goals are.
Yeah.
So that's important too. We want to find out, are they going to leave money in the United States for future investments, future oil and gas investments, or whatever? Are they going to take it back, or so? Where are they, or what are their intentions in the long run?
Yeah, and we're talking before there, Pat, about the treaty between America and Australia. So if you're paying tax in the States, then you're not having to pay tax when you bring your money over to Australia.
Right. There's a treaty among the United States and Australia that you're not going to pay double taxes, is the point.
Yeah.
You're going to be able to tax it in one country or the other.
And why do the American government give such great tax incentives for oil and gas? Because if I'm owning a share in an oil and gas company, I don't get the deduction. But if I'm investing in a company that's doing the the actual exploration and production of that, then I get the deduction. So why is the government doing that?
Well, if you invest in Exxon, for example, good company, nothing wrong with them. That's a huge corporation, and these big companies don't do the small oil and gas wells like most of the small operators do. Most of the discoveries of the new wells are by smaller.
They are, yeah. I found that out today with Sid. Yeah.
Oh yeah. So Congress, ever since the beginning of the income tax code in 1913, has had a big incentive to encourage people in this country to explore for oil and gas.
Yeah.
And so there's no better way to encourage people than by giving them good tax incentives. So it's almost like a subsidy.